Hey guys, what's up? Thanks for checking into the channel. Wanted to do a cool video for you guys today about the difference between owner-occupied and investor financing. What's the difference? And if you're here for that, thank you. Grab a paper and a pen. I'm going to share a lot of very interesting facts, stuff that you're going to probably find very, very useful. And if you do, please give this a really big thumbs up and subscribe to my channel. With that, let's dive right in. So, what's the big difference between owner-occupied and investor financing? Well, if you've ever tried to purchase a property and you didn't qualify, correct, you didn't qualify, the loan officer may have mentioned that you could try to buy it as an investor property. Why? Because when you're buying an investment property, you could actually use 75% of the proposed rent. So let's use this example, 75% of the proposed rent to offset the payment. Let's assume the payment is $1,000 and you're collecting $1,000 in rent. That means you could actually use $750, which is 75% of $1,000, to offset the payment. So your negative liability against your income is only going to be $250 if it's a rental, but it's actually going to be $1,000 as an owner-occupied. Make sense? Now, that all sounds great, but what's the negative part of me buying a property as an investment versus an owner-occupied? And here it is. So, obviously when you're buying an owner-occupied property, you're getting a much better rate. Typically 1% or higher, better on the rate. So that's a huge incentive to buy property as an owner-occupied versus an investment, again, unless I can't qualify and I need to offset rental income to boost my income. Now, if I'm trying to buy a property for the first time, especially with 3, 5, 10, 15% down, I can't do that with an investment property because an investment property actually requires that I put down a minimum of 20% down. Correct. So that puts me in a bit of a situation. If I don't have a minimum of 20% down, this could get very challenging because all the programs that you hear about with minimum down payments, they do not apply to investment properties, clearly. Now, take it one step further, actually 2 steps further. Number one, when you're buying an owner-occupied property, there's a huge incentive for you to buy the property, and if you can't afford it, you could actually get gift funds from family, okay? You can't do that when you're buying an investment property. There's no gift funds allowed, meaning that the lender wants to see that the funds that you're actually using to, one, down payment and closing are actually seasoned, meaning they've been parked in one of your accounts for a minimum of 60 days. Makes it challenging if you do not have that money available to you today. One step further, okay? When you're buying investment property, unlike owner-occupied, the lender also wants to see that you have a minimum of 2 to 6 months, typically, depending on the loan amount, it could be more, of reserves. What is reserves? Reserves is simply money that's available for you to pay the monthly payment. So they want to verify that in addition to closing and in addition to down payment. So it actually makes it slightly more difficult because now you have to document a lot more money to close than you would if you were simply buying the property as an owner-occupied, okay? Now, every single purchase requires an appraisal, okay? So if it's an owner-occupied, it's a simple, it's called the 1004 report. It's approximately $500, obviously, all depending on the size of the property. If it's much larger in a different area, more unique, it may cost more. But if you're buying an investment property, not only do we have to order an appraisal, but we also have to order a comp schedule. Comp schedule is called a 1007, in addition to a 1004 appraisal. And typically, because remember, we spoke about offsetting 75% of the payment with the rental income. What is the rental income? Well, you could propose a lease, but how do we know that that's in line with the market rents? That's why you need a comp schedule. The appraiser will actually do a comp check and let you know, you and the lender, approximately how much money this property can collect, and then the lender will use that to offset the payment. All right. So hopefully that makes a little bit of kind of puts things in perspective, I guess, as to what the differences are and why one might buy something as an investment versus an owner-occupied. Clearly, it's easier to buy an owner-occupied property, but if you must have the property and you just don't have enough income to qualify, but you do have reserves, then buying it as an investment does make sense. Now I'm going to answer one last question, which is likely on your mind right now. If I buy a property as an investment property, could I ever move into the property? And the answer is yes, of course. As long as you're making the payments on time, you're good to go. All right. So with that, appreciate you guys watching. As always, if you enjoyed it, please give it a big thumbs up. Subscribe to my channel. I'll catch you guys on the next video. Thank you.